The Federal Reserve cut interest rates in September. This was a big move. They did it to boost the economy. The Fed hopes lower rates will encourage people to borrow and spend more. This can help businesses grow and create jobs. The Fed's decision came after a period of economic uncertainty. Inflation had been a concern, but it has recently cooled down. The stock market has been volatile. There are also worries about a potential recession. This rate cut is a sign that the Fed is paying close attention to the economy. They are taking steps to try and keep it strong. It remains to be seen what the long-term impact of this rate cut will be. Inflation has dropped to a remarkably low 0.1%. This is the lowest it's been in a long time. Low inflation means that prices for goods and services are relatively stable. This is generally good news for consumers. It means their money can buy more. There are several reasons why inflation has cooled down. One reason is that oil prices have fallen from their highs. Another reason is that the strong dollar has made imported goods cheaper. The Federal Reserve's policies have also played a role in keeping inflation in check. However, some experts worry that very low inflation could be a sign of a weakening economy. They argue that it could lead to a deflationary spiral, where falling prices cause businesses to cut back on production and jobs. This is something the Federal Reserve will be watching closely. The stock market has surged by an impressive 12% during this election year. This is a common pattern. Investors tend to be more optimistic in the months leading up to a presidential election. They are hoping for policies that will boost the economy and corporate profits. Election years are often marked by uncertainty. Investors don't know who will win or what policies the new president will pursue. This can lead to volatility in the market. However, history shows that the stock market tends to perform well overall during election years. This year's rally has been fueled by a number of factors. These include strong corporate earnings, low interest rates, and optimism about the economy. However, it's important to remember that past performance is not necessarily indicative of future results. Section 4. The Presidency and the Market. Democrats versus Republicans. There is a long-standing debate about whether the stock market performs better under Democratic or Republican presidents. This debate has been fueled by various studies and analyses over the years, each presenting different perspectives and conclusions. Historically, the stock market has generated an average return of 9% under Democratic presidents. This statistic has often been cited by those who argue that Democratic policies are more favorable for economic growth and stability. Under Republican presidents, the average return has been 6%. Critics of Republican economic policies often point to this figure as evidence that their approach may not be as effective in fostering a robust stock market. There are a number of factors that could contribute to this difference. Economic policies, global events, and even the timing of economic cycles can all play a role in influencing market performance. One theory is that Democratic presidents are more likely to pursue policies that are seen as beneficial to the economy, such as government spending and social programs. These initiatives can stimulate economic activity by increasing consumer spending and creating jobs. Republican presidents, on the other hand, are often seen as more business-friendly, with policies such as tax cuts and deregulation. These measures are intended to boost corporate profits and encourage investment, which can also have positive effects on the stock market. However, it's important to note that there is no clear consensus on why the stock market has performed differently under Democratic and Republican presidents. The relationship between political leadership and market performance is complex and influenced by a multitude of factors. There are many other factors that can affect the market, such as global events, economic conditions, and investor sentiment. For example, international trade agreements, geopolitical tensions, and technological advancements can all have significant impacts on market trends. Additionally, the specific policies and actions taken by individual presidents can vary widely, even within the same political party. This means that the economic outcomes of different administrations can be quite different, depending on the unique circumstances and decisions of each presidency. It's also worth considering the role of Congress and other branches of government in shaping economic policy. While the president has significant influence, many key economic decisions are made through legislation and regulatory actions that involve multiple stakeholders. Ultimately, the performance of the stock market under different presidents is just one piece of a much larger economic puzzle. Understanding the full picture requires looking at a wide range of factors and considering the broader context in which these policies are implemented. As we continue to analyze and debate the impact of political leadership on the economy, it's important to remain open to new information and perspectives. The dynamic nature of the market means that there are always new developments and insights to consider. A glimmer of hope indeed, but one that requires careful consideration and planning. Section 6. The rent crisis. Why are prices still so high? This is a question on the minds of many renters across the country. Despite various economic changes, rent prices have not seen a significant drop. Rent prices remain stubbornly high in many parts of the country. This is a pressing issue that affects millions of people, from young professionals to families trying to make ends meet. This is despite the fact that mortgage rates have declined. Lower mortgage rates typically make home buying more affordable, which should, in theory, reduce the demand for rental properties and lower rents. There are a number of factors contributing to the rent crisis. It's not just about mortgage rates, it's a complex web of issues that need to be untangled. One major factor is the shortage of affordable housing. Many cities have not kept up with the demand for new housing units, leading to a significant gap between supply and demand. There simply aren't enough rental units available to meet demand, especially in major cities. This shortage is particularly acute in urban areas where space is limited and construction costs are high. This is driving up prices. When there are more people looking for apartments than there are available units, landlords can charge higher rents. Another factor is the strong economy. A robust economy means more people are employed and have disposable income, which can increase the demand for rental properties. When the economy is doing well, more people are employed and have money to spend. This can lead to increased competition for available rental units, further driving up prices. This can lead to increased demand for housing, including rentals. As more people move to cities for job opportunities, the demand for rental properties continues to rise. The high cost of rent is a major burden for many Americans. It affects their ability to save for the future, pay off debts, and even cover basic living expenses. It can make it difficult to save money, pay bills, and make ends meet. Many families are forced to make tough choices, such as cutting back on essentials or taking on additional work to cover their rent. Policymakers are looking for ways to address the affordability crisis, but there are no easy solutions. Efforts to increase the supply of affordable housing, provide rental assistance, and implement rent control measures are all being considered. However, these solutions take time and require significant investment and political will. In the meantime, renters continue to struggle with high costs and limited options. The hope is that with continued effort and collaboration, we can find ways to make housing more affordable and accessible for everyone. Section 7. Navigating the financial landscape. Understanding the interplay of factors. The financial markets are complex. There are many factors that can affect the prices of stocks, bonds, and other assets. It's important for investors to understand the interplay of these factors in order to make informed decisions. Some of the key factors that investors need to consider include interest rates, inflation, economic growth, and geopolitical events. These factors can all have a significant impact on market sentiment and investment returns. It's also important for investors to have a long-term perspective. The markets go up and down in the short term, but over the long term they have always trended upwards. By staying invested and riding out the volatility, investors can increase their chances of achieving their financial goals.